Hello, friends. Once again, I welcome you back. So, this is episode 5 of the institutional trading series. And today we are going, today's part is part 2 of yesterday of the previous video. So, I'm going to be talking about almost the things that I talked about yesterday, but talking more about the issue of order blocks. So, we are going to be identifying order blocks using discount premium theory and fair value gaps. So we shall get examples both in synthetic indices and forex. We are going to start with forex. So basically, we talked about a lot. I talked about discount premium theory. In episode 3, I talked about the fair value gaps. So these are not new terms. So I would request and encourage you to go and check out. You can just check out that playlist. It's called Institutional Trading, and then you will understand more. So yesterday I had some simple illustration where I illustrated that we are retail traders, you and me, we are retail traders. Now we have our accounts with a broker, and then there is what we call a liquidity provider. So each one of these parties is here to make money. So basically, the broker is a middleman. They take your orders and then they place them in the market. You get you access the market through through the broker. So which means there must be a liquidity provider. Why am I calling this person a liquidity provider? So that person must be having money ready if at all you are buying the market. You get if you are told you are buying the market and then it goes up, that person should be capable of having all the money that you've won to take it. You get through the broker so that they can give it to you. You get there is this liquidity provider. So the liquidity provider, these are large institutions. I told you, you try to Google the trading volume, the daily trading volume of Forex. It's about 6 trillion US dollars. So this is a lot of money that flows through the markets on a daily basis. You get? So basically, the broker makes money through commission and spread. You get? And now for us, we are battling, retail traders, we are battling these liquidity providers. Now, liquidity providers are rational. By rational, for them, they have the power to move the market because they have more money, which means we don't have to think like retailers. We have to study more about these liquidity providers because they are the ones moving the market, so that if they're moving the market, we move with them because we are all here to make money. If you're winning, it means you're taking off some money that they would be having, and then you are taking it. You get? So which means these are people, all these institutions are having a lot of resources. So we need to be understanding and study them more. You get? So that's just a quick reminder of what I talked about yesterday. So now let's proceed. Still, we are going to be reminding ourselves more. So yesterday, that's why I introduced discount premium theory. You get? So as of yesterday, we're dividing the market into two. So an impulse run that is moving, let's say from up to down or from down to up, we're dividing into two. You get? So we can use a Fibonacci retracement tool. So any level above 50 is premium, and any level or any point below 50 is discount. You get? So which means supply always is up, or some people call it resistance. I told you these terms are the same. Supply and resistance are the same because basically we mean that if at all the prices were moving from down to up and they reach resistance, they have to sell. You get? It is the same thing with supply. If they are moving from up to down and they reach a supply level, they sell. You get? That's what I brought out yesterday. They are the same because we don't just look at words themselves, but we look at the call to action that these words signify. If at all we were moving from up to down and we reach demand, then we buy. The same thing, if at all you're moving from up to down, you reach support, then you buy. So there's no difference. You get? And yesterday I illustrated to you that given that these institutions are rational, given that they are rational, if they wanted to buy the market, you get, if they wanted to take the market up, because basically if you place a trade of with let's say 10 lots, these are placing, and someone places a counter trade of about 100 lots. It means for you, your 10 lots will be taken. If at all you are buying GU with 10 lots and someone sells it with 100 lots, it means it will come down instead of going up. You get? So we need to understand that. Now, which means these institutions, given that they're rational, if they wanted to buy the market, if they want, because it means they want to take it in premium, you get, they will move from up, they come and tap into discount where prices are low, and then they come and take profit there, you get. So they come and take profit there. The same thing that really happens if at all you wanted to sell and you are in business, you go, if you wanted to sell, you move from a place where prices are low, you go to an area where people are paying more money, and then you you would sell. You get? You would sell. So I believe now you can understand. You can understand that if we want to buy, we move from where prices are high, we come to where prices are low, we come and take profit there. So we want to be applying this concept or this illustration as we trade. It really takes time. That's why I told you some of you are having good content, but then you've not done enough practice. It takes time to apply this concept on these candles. You get? And basically, you're going to find out that in future we shall find out that those kind of moves are the ones that form a candle wick. You get? That form a wick on the candle. You get? Those moves that are happening are forming the candle. So if I told this is a bearish candle, you get, if it's a bearish candle, I told you, let's say, supposing it's a bearish daily candle, I told you we are here. We want to sell. We go into we go into premium where prices are high, then we sell from that point, you get, then we come, you get, because the next candle has to continue, then the next bearish candle, what does it do? It first goes into premium, then it goes like that, you get. So basically this kind of move makes our, from here to here, this is our candle body, you get. So these things really take up a lot of time, and this is the candle wick, you get. So there is a lot of economics that happens as it's forming, you get, as it's forming. And then time comes when you have to generalize candles into zones or regions, you get, as it comes to zones or regions. But these things are understandable, they're understandable. So let's try to to look at some examples. Let's try to look for order blocks, given that we've identified discount premium. By the way, now, even before we leave this place, for a bearish order block, you get, a bearish order block is a supply zone or a resistance zone, you get, and a bullish order block is a demand zone or a support zone. So basically, even these words, we can add another term, order block. You get, bullish order block, demand, support, they are the same. Then the same for a bearish order block, supply, resistance, they are the same words. You get, so don't get confused. So I've realized that some of you get motivated by the word order blocks. You get the word order blocks. You think it has money in itself. Not really. So we are going to first look at this example of gold. This is gold H1. I request that you guys, you go and watch it right away. So later on, uh, in upcoming videos, I'll be reintroducing something called a zone, a flip in markets, flips, zone flips here. So there are those pivot points that we shall be looking at. So basically, what I wanted to bring out is that we are identifying order blocks using supply, using discount premium. You get? So basically, we can see that in this region here, we got a break of structure. You get? We got a break of structure at this point here. You get? It was a break of structure. So, and then we got a shift. Actually, we got not just a break of structure, but we got a shift in market structure. You get, that's what I wanted to bring out. Just because the market previous was coming from up to down, and then we got a shift in market structure, and then we got up. So not just a break of structure, but we had gotten a shift in market structure. Now, what do I really want to point out? This is what I want to point out, is that we have this impulse run. We started, the market was coming down, but we can see that we got a shift in market structure. One of the things we want to apply discount premium. So now we may not be knowing. Sometimes we have to wait, and then based on history, the institutions, for them, they knew that they were going to move the market from this point to up here. But given that for us, we base on what has already happened to place our entries, then we first look for the footprints that have been left behind to 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 identify where to get in. So basically now we can see that we had this impulse run that happened. For us, we want to be part of this move that is continuing the market. You get? So now there's this impulse move. It started down here, but we have this candle that is coming down here. You get? So basically, our impulse run that started down here, it was intercepted by this order block or this manipulation that came down. So it was really possible that the market could come and tap into. Uh, I don't know why my charts are just reloading themselves, but it's fine. Let's go back. So it was really possible that the market would come and tap into this zone here, and then we buy it. You get? We buy it. But then sometimes these people, they really know that most people would be waiting for that confirmation of when the market would tap into that part, and then they buy. So basically, for them to move the market to this point, to this point, I've taken profit here. Yeah. For them to move the market to this point, given that it's money that moves the market to this point, sometimes they may be losing too much sometimes, but then we want to identify using discount premium. Now, this impulse run, we are going to measure it from here to up here. You get? So someone was asking, can we use a normal Fibonacci retracement tool? Yes, this is a Fibonacci retracement tool that I'm also using. I've only eliminated some levels. Let me quickly show you. You see, I've only left level 00, 50%, and then 100%. The rest I've deleted them. You get? So it's not something like that is new. So we can see, I told you, we want to if I to, they want to buy the market, which means most times they have to tap into discount. You get, where prices are low, so that they can come and take profit up. You get? So that they take profit up. Now this is what we want to apply. So now when we measure, you get, we shall be keen on looking below level 50. Now the market reversing, what is one of the main reasons? It's because we got a shift in market structure, and then we got this large displacement. These displacements with imbalances, you can see that these are large bullish candles. These are some of the things that the market would be coming to correct. Much as the whole of this is like an imbalance, but we are most interested in what we call sometimes the fair value gaps. You get? Fair value gaps, I told you, they're those parts of the candle body which are not violated by a candle wick. You get? So now when we look at below level 50, what are we looking out for? We are looking out for our fair value gaps. So you can see that already this point is below level 50. Now I want to eliminate this. I want to remove this Fibonacci retracement tool very fast. So we can see that we have this fair value gap here. You get? This fair value gap here. So now the moment the market reversed down like this, for us, would be looking for what is most of the time we are going to be looking out for what is this side. You get? Most of the time you're going to get that candle or a zone flip, but we shall be looking at a couple of examples. But now, generally, for me, I would be placing entries in this fair value gap. You get? In this fair value gap, because it's something that is below level 50, and now it's one of the things, because we know this is not a run that is going to come from up here to down, but it is looking for, we are looking for a point below level 50, below, which means that is, we are looking for prices in discount, you get. But I told you we reverse with a reason, you get. My MetaTrader is no, my CTrader is reloading, but let's go back here, you get. Let's go back here. So we can see uh, what I wanted to say is that you find out that the market, where was I? Yeah, this is the point, you get. So you find that we are looking for, this is let me measure it up again, you get. So basically this is what I was trying to illustrate for you, you get. So already we've tapped into discount, and what are we seeing here? We are seeing a fair value gap, you get. So which means in this zone, this is a valid zone where we would take, or where we would place our entries. So I'm trying to confirm to you that sometimes, and actually, when I was introducing fair value gaps, I told you they are mostly going to be helping us on the part of retracements, you get, or pullbacks. Now you can see that the market was pulling back. By the many times, pullbacks fall into fair value gaps. Many times, you get. So the moment the market came and tapped into this fair value gap, we can place our entries in this region, and then we buy the market, you get. We buy the market to go up, you get. So basically that's it. And now uh let me see, there is another example that I had over this side before we even, no, let's first check out the example of synthetic indices, you get. So basically we've seen that. Now let's go to synthetic indices. So the same thing happened when we got a shift in market structure here. This is volatility 75, the daily time frame. I always mention these time frames because I want you people to go and also try to apply the things that I'm talking about here on the charts, you get, for most of for those that watch the videos right away. So we can see the same thing happened. But then I want us to analyze, there are some differences that at times happen. Let's look at this impulse run that really happened from up here to down here, you get. Because given that this is a business of manipulation, always be careful. Always be careful. So we can see that whatever was happening here, let's assume that we were not understanding it until this point when we broke structure, you get. When we broke structure, so the moment we break structure, we always look at that impulse run that has broken structure, you get. Why? Because uh, there's something, though, that I told to my students. The, most of the time when we break structure, it's an implication that now this point where the impulse run has started is protected, and then this point is targeted. So which means it's one of the indicators that now the market is willing to proceed even from this point where it has ended, but then to continue even further down, you get. Because we protect up, and then down is, and it is targeted, so we continue targeting down. So we can see that in this move here, much as we started up here, but then we can see that there was some kind of manipulation here, you get. We have these up close candles, you get. So where would I be measuring off the real impulse run that broke structure here? I'll start from this candle here, you get, this impulse run, and then I end here where the market turned to go up. Because now I've broken structure, I know I'm not coming anywhere above here, you get. Now I'm looking for a place or a region where the market would be looking for to sell at high prices. We sell at high prices, I told you. We move from these areas where prices are low, you get, where prices are low, we tap into areas where prices are high so that we can sell there, you get. So I want us to be smart enough for us to be selling at these impulse runs. But nonetheless, if I told the market was turning here, given the time frame that it's a daily time frame, and I know this is the point where they're going to be selling, it means it can act as my take profit from this point to this point, you get, to that point. So now Sometimes it will require you to go on a small time frame. Now, the area, this area here was mostly clear on H4 and H1, you get. But then I'm not going to be dropping on those small time frames, you get, because I told you some of these things it would take up a lot of time if I went into each and every detail. It takes up a lot of time, you get. But then at least you've gotten the concept. We tapped into our premium part to sell. We sell at premium and then we buy at discount, because I told you these institutions are rational. They make rational decisions. You get, they're here to make money. They don't come casually like many of us. You come with the way you feel like, you get. And now, if I can give another illustration, something still that I talked about yesterday, you get, on VIX 75, we can see that we got a shift in market structure also. You get, by the way, I told you even yesterday, uh, we are buying VIX 75, which means we are going to have longer impulse runs that are bullish, you get. And now, the more I give out content, I believe the more you will come to understand and learn why I'm talking or I'm telling you that, you get. So now, even on VIX 75, we can see that yes, the market, this was the last candle. This was the last candle that was bearish, you get. But then for us, we want to measure off the impulse run that broke this structure, to look for to look for a discount price, to look for a discount point where the market would be buying. You get, where the market would be buying, because we may not know. It is possible that we didn't know that the market would come here, but at least I told you, we base on history to look for those points, or those for those points actually where the market is really intending to go, you get. So when we are to measure off from here, the impulse run where it started, to up here before where we started getting this pullback, this reversal, we can see that prices came and tapped into our discount discount part, you get, our discount part. Now the same thing happens on H1, you get. On H1 there was a confirmation. It wasn't a fair value gap, but other confirmations. I told you, not only fair value gaps and then maybe discount premium are the only confirmations to entry, you get. There are other confirmations, but so far at least I've identified for you fair value gaps are some of the things that we look out for. Sub Here on H1 actually, let me be straight to you, we found out a supply and demand zone, you get. But basically here, if I told you we're placing entries, the moment we come below level 50 and then we've gotten a shift in market structure, trust me, more so if I told it was a lower time frame entry, my stop loss would be below this point here. Trust me, if I told the market went really below here, trust me, there it will be a wrong entry, you get. So here it gives you a nice risk to reward, you get. This one being target one. I'm not telling you guys to go and just jump onto the trends, you get, because this is the day time frame. It's really tricky. Some of you will be lucky enough, but then I'll be here in future to review ourselves, you get. So we are bullish on, or are bullish on VIX 75, you get. So there's another illustration that I really wanted you to know, but my platform here is not loading well. But for now, I believe I believe I believe we've gotten some nice information, you get. We've gotten some nice information. If at all there's something that I really wanted to show you, but that will be for another episode, you get. That will be for another episode. And now I wish you the best and peace.